Hi everyone, so today we are going to do a new company called Thomson Reuters. This is going to act as a stock analysis video. I have not covered this company before, but recently it's been in the news because it has had a major sell-off. The prices have been collapsing because of Anthropic, but we'll get into that in a second. But let's go back to the beginning, and I'm going to first share my screen to what they actually do, how they actually generate revenue. So let me go ahead and do that, and thankfully Gemini makes it quite easy. So Thomson Reuters, they're a Canadian company, first of all. They're a leading provider of business-critical information technology and insight for legal, tax, accounting, compliance, and governmental professionals. They combine specialized software with AI-driven intelligence such as Westlaw and Checkpoint to help professionals manage risk, ensure compliance, and make informed decisions while also delivering trusted news via Reuters, which obviously people probably have heard of. It's like the New York Times is pretty popular. Legal professionals offers, so these are the areas of operations: legal professionals, tax and accounting that provide software for that. Research, government supplies information, investigative tools, and technology to public sector agency, and Reuters News, obviously. So just to give you an idea of what they actually do. Now, we're going to take a look at their most recent earnings, which came out today. So we're going to take a look at see what happened for Q4 2025. And for Q4 25, looks like they actually did well. They beat by 1 cent, and they also did well on revenue. So revenue rose 5% reported, 7% organic to $2.01 billion. Adjusted EPS increased 6% year over year. So really good for them. The whole full year for the quarter ending in December 31st, 2025, or the full year, excuse me, total revenue was up 3% and 7% organic growth. We have adjusted EPS of $3.92, an increase from $3.77. And yeah, so I would say overall it looks pretty good. Obviously the revenue growth I don't like. It's very small, but it's not like it's losing money, so it's good with that in mind. Now, this is what I was referring to before. Yeah, the stock has been down, I think 35%, 47% since July 5th, 2024. So let's say a little more than a year ago. Reuters had a big sell-off this week, 18% plunge over 3 days due to fears of AI disruption, and that's because of Anthropic, which launched new legal automation tools for its Claude chatbot, which investors feared could directly compete with Thomson Reuters' core legal research and contract review business. Essentially, obviously, a lot of software stocks have been selling off significantly because of this. Reuters is no different. Also, S&P Global has been selling off, Moody's as well, because of this AI disruption with Anthropic. It's very interesting to see this AI panic that erased significant shareholder value. The company reported solid fourth quarter, like I said, beating analyst estimates. But yeah, it just pretty much continues on that they did well, but super, super interesting. The next thing we're going to take a look at is Simply Wall Street. Now, with all this in mind, Simply Wall Street's going to say that it is currently 1.8 billion. The next 3 years, it's going to be 2.55 billion. So it's not a double. It's certainly slowing down in growth as per revenue. The revenue is very small. It's like 3%. So of course, it's going to be small. The financial health of the company is really, I don't like this. A lot of debt, not a lot of cash. Equity is going slightly down. So, it's not that bad, but it's not that great either overall. Now, when we take a look at my DCF is going to say that it is 17% overvalued, which probably I agree with. Wall Street forecast is going to be a little bit more fair. They're going to say it's 3% overvalued. Probably what's going to happen is Tipranks and AlphaSped are going to re-rate the stock because of what's happening with the sell-off. I've seen it before. Now, the stock currently, we're going to take a look, is trading at $88 a share. We have that it's a 52-week low of 85 and a 52-week high of 218. Now, it's had a major sell-off. It's near the 52-week low mark. It could get lower, of course. You never know with this market how it could be. Now, when we check the net income to see what's going on here, if it's profitable, it is profitable, but it has been decreasing, so you should be aware. 5.689 billion and then now it's 1.75. So it has been significantly decreasing, so you should be a little bit aware of that and be cautious of that. Now, when we take a look at, lastly, Tipranks, Tipranks is going to say that it is a strong buy, 6 buys, 2 holds, an 8 rating, 87% upside, low 177, average of 227. So, yeah, I mean, I would still urge caution because of the model of the business and the other metrics. So, yeah, I would probably wait until maybe get a better price, but I just honestly overall I don't really love it just because the revenue growth is only 3% year over year. I don't think that even beats inflation, so it's not great when it comes to that either. All right, thank you everyone.